Hey everybody, Josh here with Presidio Advisors. So today I wanted to share my framework on how I work with clients to best align personal goals, such as buying a house or paying for a wedding or saving for retirement, with different investment vehicles that have different risk profiles and return expectations associated with them. So this is what I call my bucketing approach. And what I like to do is to literally have clients set up three separate accounts where each account represents a bucket, and then I'll have clients label each account as bucket one, short term, bucket two, midterm, bucket three, long term. And sometimes clients will even add a fourth account or bucket, which is used to house play money, so to speak. And this is where we're essentially allocating money to gamble with for fun, not to invest with. And clients are deliberately taking calculated moonshot bets that could either do extremely well or could be likely to crash and burn and could very well go to zero. So high volatility assets are really comprised of bucket four if we have one. So if we walk through this bucket one short term, this is really cash that we are going to need for sure, definitively within the next year. It's taxes owed, daycare costs, insurance premiums, wedding costs, whatever it is. We know we're going to need this cash. So we really don't want to take any risk, quote unquote, associated with this money. And we want it to be very liquid, very safe, very accessible. Of course, we still want to generate some sort of return, which means that often this bucket is invested in US Treasury bonds or money market funds or high yield savings accounts, et cetera. And we will try to optimize for tax efficiency within bucket one, and for that matter, all of these buckets. So, tax efficiency, but also liquidity, safety, and accessibility are really what define this short term bucket. Bucket number two is what we'll call our midterm account. And it's really comprised of assets that we're probably going to need within the next 2 to 5 years. So maybe we're thinking about buying a house in a few years, but maybe we're also of the mindset that if the market tanks for whatever reason, we're okay with deferring that house purchase for another 3 to 5 years or so, or however long it may be. And so what that means is that, okay, we're okay with potentially deferring a major expense. Then maybe we can afford to take a bit more risk with bucket number two, meaning that we'd probably have more exposure to stocks and equities in the hopes of generating slightly greater returns. But on the flip side, maybe there's going to be a wedding in 2 years. And unfortunately, you can't defer the costs and expenses of a wedding. So in that case, we're probably not going to want to take equity risk with that cash because in the event of a market downturn, we don't want to be forced to sell these assets at a depressed value, which would permanently destroy wealth. So in this situation where we can't defer a particular expense that we know is coming up within the next, call it 2 to 5 years, the investment holdings in bucket two are likely to be pretty similar to those in bucket number one, which is what we have listed here. So US Treasuries, CDs, bonds, high yield savings accounts, those are pretty similar to bucket one if we really can't afford to take that much risk. And then we have bucket number three, which is our long-term bucket. This is cash that we're not going to need for at least ideally 5 to 10 years, ideally longer than 10 years, honestly. So within bucket number three, this is where we're allocating your retirement accounts, your 401ks, your IRAs, your taxable brokerage accounts that you're not going to touch until you retire, at least for a very long period of time. This is also probably where we're allocating 529 plans for your kids that you're not going to use for the next 10 to 15 years. And this bucket is really where we take higher risk, seeking higher reward by investing in equities, meaning well diversified stocks. And we know that in bucket number three here, we're probably going to see a lot more volatility, but we're okay with that because we also know that volatility is really the price that we pay for higher anticipated annualized returns. So these buckets are really what define approach to segmenting investments based on use case, based on time horizon, and based on risk appetite. So now let me show you a little bit more about why I've landed on these specific time horizons, and specifically, why am I defining bucket one as 0 to 1 years, bucket two as 2 to 5 years, bucket three as at least 5 years? The reason is because of this data. So this chart shows the historical risk and return profile of the S&P 500 for the past 98 years or so. And what you're seeing, particularly in this second column here, the range of annualized returns, is that over any 1, 2, 3, or 5 year time period in history, what the range of annualized returns would be. So, for example, if you invested $100 at the beginning of, let's say, any 2 year stretch, which is right here, your $100 would have turned into $42, which is a big loss, or it could have boomed to $200. And you'll notice on the right here that we also have this column where we have the period of negative returns as a percentage of all years. And the way to interpret this far right column is that historically, for example, over this 1 year time period, there has been a 26.8% probability that on any given year, the market will be down. So basically, over the course of any year, there's 1 out of any 4 years are generating negative returns. And that percentage improves or declines as the holding period increases, all the way to the point where for any 15-year stretch in American history, or 15 years or greater stretch in American history, I should say, the S&P 500, which is comprised of the 500 largest US stocks, has never had a negative annualized total return. So, for any 15-year period here, what we can see is that the annualized returns have ranged from zero point 0.6 per year to 18.9%, 18.9% per year. So $100 annualized at 0.6 per year would be about $109, all the way up to $1,341. So of course, past performance, no guarantee of future results, but this is historically how the US market has performed. Now, you may be thinking to yourself, well, okay, if there's only a 26% chance of a negative return in any given year, then I'm going to take that bet because the inverse of having a 74% chance of positive returns is pretty solid. And this is true, and it's ultimately your decision. But what I would tell you personally is that I would not take the gamble. And the reason that I would not take that gamble is because if we pair this chart with this additional data that you can see on the right, we get a much more holistic picture of what's actually happening in between all of these years. It's not just you invest for 1 year and then poof, at the end of a year, you have a 76% likelihood that your money has generated some sort of positive return. What this new data is actually adding to the picture is that even though 3/4 of years have historically generated positive returns, the vast majority of years also have fairly substantial intra-year drawdowns. In other words, there's a ton of volatility, and you can see that through the third column in each of, or the third column in each of the three columns where we see these drawdowns. And this is where I think human irrational emotional behavior really starts to play a big role, because as humans, the reality is that we're just very prone to making rash decisions when we get nervous. And that rash decisioning, I think, is particularly acute if you need any sort of cash in the short or the midterm, simply because you don't have the time to wait for a market rebound. So you're much more inclined to pull your money out of the market at the wrong time. And if you pull your money out of the market at the wrong time, that can lead to permanent wealth destruction, which is really what we want to avoid. So to me, I always think about investing as a long-term gain through the lens of this historical data. And of course, we don't know what the future is going to look like. We could continue to have periods that are reminiscent of 2009 to 2017 here, where it was just continued, annualized growth. But we could also have periods similar to 2000 to 2002, sustained losses, and that could be a big problem. And even if we, have the 2009 to 2017 periods, we still can see that there were, pretty immense drawdowns during those years, and those drawdowns can easily spook people. So even though we really don't know what the future holds, it is pretty certain that no matter what, we're going to have a lot of volatility, and it will be tempting to pull that money out of the market entirely, try to wait it out, try to, wait for a better opportunity to jump in, and that is not what we want. So I'm going to end here with this quote from Morgan Housel. And I know it's corny. Morgan wrote a great book called The Psychology of Money. If you haven't read it, I highly recommend it. And to me, this quote is just so powerful, and it's one that has really framed my perspective. So he writes, no one wants to hold cash during a bull market. They want to own assets that go up a lot. You look and you feel conservative holding cash during a bull market because you become acutely aware of how much return you're giving up by not owning the good stuff. Say cash earns 1%, stocks return 10% a year. That 9% gap will gnaw at you every day. But if that cash prevents you from having to sell your stocks during a bear market, the actual return you earned on that cash is not 1% a year. It could be many multiples of that because preventing one desperate, ill timed stock sale can do more for your lifetime returns than picking dozens of big time winners. Compounding doesn't rely on earning big returns. Merely good returns sustain uninterrupted for the longest period of time, especially in times of chaos and havoc, will always win. And I just really subscribe to this philosophy here. And I know, and now you know what the data shows. So those are my high level thoughts. You are totally free to agree or disagree. You are the CEO. I am the CFO. I give you my thoughts, but ultimately you make the decisions. And now you can make a more informed decision about allocating your investments. So any questions, just let me know and hope this was helpful.